Welcome to Alliance Insights. Today's session, Business Uses of Life Insurance, is led by Tyler Jensen, President of the Top Performance Group. This program is brought to you by the Risk and Insurance Research Academy, which advances education, research, and the next generation of talent in the risk and insurance industry. If you'd like to get involved or hear more about our work through the high school and university levels, follow us on LinkedIn, YouTube, head on over to our website, share our story, or even consider making a donation to our Emerging Talent Partners program. Now, let's get to why we're here. We are thrilled to have you with us, Tyler. Thanks for joining Alliance Insights.
Yes, thank you so much, Noelle, for having me again.
Again, yeah, well, anytime you want, truly. So thanks again, and good luck with the session.
Hey, thank you so much, Noelle. So excited. And thank you for watching this and being a part of it. I'm so excited to share a valuable tool, an essential tool for business owners to understand and allow you to present these to business owners. And ultimately, you protect families, you protect the business employees and the legacy of your company through the use of life insurance. And so this is ultimately, it's designed to help you understand several key aspects from key person insurance agreements, buy-sell agreements, life insurance as cash value accumulation vehicles, life insurance to secure loans, lines of credit, as well as employer-sponsored plans. We're going to cover all of that today in this section. And just several really just kind of key aspects. There's kind of that introduction I just went through, showcasing what we're going to be talking about. But really behind this, I want to just touch briefly on just a few key concepts of life insurance. So that way we're kind of all on the same page behind this as we're discussing these throughout the day. And so just plain and simple as we can be, defining what is term insurance, what is permanent insurance, and what are the parties to a contract. This is as simple as I could make it. Term insurance is exactly how it sounds. It is temporary, right? Term is short for temporary. It's a terminating policy. It's temporary mortality protection for a set period. There's no savings elements involved, unlike our permanent counterpart, the permanent insurance. Now, this provides mortality protection and saving elements that can grow over time and can be accessed by the policy owner before the insured actually passes away. Now, there's also parties to a life insurance contract. There's the insurer, so that is the insurance company providing the contract, the policy owner, and that is the one responsible for items such as payment and making changes to the policy, as well as the insured. And this is who the policy is written on behalf of. This is the life that we are protecting and insuring. And then we have our beneficiary or beneficiaries when there's multiple, and those are the recipients of the declared death benefit on the policy. So really, let's get into really our first one. And I can't share anything without a little magic within our life. So we have a little magic trick, because when it comes to a key person policy, I want to tell you the story of our lead architect. Okay. It was a startup tech company, fast-growing startup tech company. And this lead architect had a pivotal role in the valuation of the company and essentially building the entire process. Okay. And from that, he had the confidence of the investors. He knew exactly what was going to happen. He was helped building the product. But then tragedy strikes. And unexpectedly, he passed away. And now the company is left with all of these crazy, jumbled pile of mess. Because now, what's going to happen? They could lose clients. They could lose revenue. And they could also lose credibility behind exactly what they're doing. And so if they didn't have a plan in place, they're going to be hit with all different setbacks and trials. But luckily, we had a $2 million key person insurance policy in place. And what that did is that death benefit allowed them to recruit a new leader, cover the lost revenue, transition the new employee, and retained the reinsurance of the investors. And that's the value of a key person policy. This is essentially what a key person policy looks like, right? In simple terms, it is a policy that the business can purchase on the life of an employee. Now, a business has ultimately insurable interest in its employees due to the fact that if the employee were to pass away, it would put a financial strain on the company. And the purpose of this policy is to offset financial loss if a vital person passes away. So these type of policies, right, as you can see through this illustration, we have that key person purchased on behalf of the company. Premiums go to a life insurance company, and that death benefit comes back to the business if they were to pass away. Now, these types of policies, they're typically going to be a term policy where that business will pay the life insurance on the employee, and the business receives the proceeds as the beneficiary. So if that key employee passes away, the business gets that death benefit and be compensated for that loss. Now, there are several common losses that are associated with employees, okay? So it can be decrease in production. It could be their knowledge and development. That could indicate that they are essential. It could be if they're developing software for a company, if they're going to be offsetting lost sales, repay loans and maintain credit, or losses associated with rehiring. Okay, so what are some factors, and when is this helpful? Factors that you really consider for these individuals. Okay, so some factors would be revenue replacement, number one. Okay, so we can actually estimate how much of the company's revenue the key person directly generates or influences. For example, if you have a top salesperson, their impact could be measured in annual sales volume. You could also look at the recruitment or the replacement costs associated with that employee. So some of these factors would be the expense of recruiting. It could be onboarding. It could be training a qualified replacement. And then often includes the headhunter fees, the signing bonuses, and also relocation costs. Other ways that we could look at some factors in determining that death benefit would be human capital valuation. Now, this is one that is most commonly used throughout the industry, and it's a multiple of salary, contribution to profits, as well as replacement cost. Okay, so it kind of combines them. So essentially what we do is we take a multiple of salary. Typically, it's going to be 5 to 10 times the key person's compensation. So you get salary and bonuses, and then you times it by that 5 to 10%, or 5 to 10 times. And that's a good rule of thumb. And then the next, you look at the contributing profits for that individual. Okay, so looking at contributing profits, you can multiply the individual's contribution to annual profit by the number of years needed to replace that level of contribution. And then we add in the replacement costs. So this is adding up recruiting, training, and lost productivity. Some other items to look at and some benefits also with these key persons are the tax considerations. Okay, so there are tax considerations when looking at these policies. And note that premiums are not deductible on these. Okay, you cannot deduct premiums, but the death benefits are tax free. Okay, if they have the notice and consent in the rules of IRC 101. Okay, just throwing those legal terms out there so you can look those up. But they have to meet that providing notice in order to obtain the consent, and they have to obtain consent from the insured in order for that to be justified. Okay. Now, these key person policies, when they leave, this is a common question we'll get. When somebody leaves the organization, can these policies be reassigned? And yes, they can be reassigned, though new insurable interest rules will apply to that new employee. Okay, so does this even happen in the real world? Like, do companies even use this? Yes, it is very common, and even some of the best, largest companies in the world use these policies regularly. Okay, Starbucks, right? They disclose in their SEC filings, right? And they actually carry a $12 million key person policy on their founder, Howard Schultz. Okay, why? Because it's not just an executive, right? He is the face and the culture of Starbucks. So a sudden loss would cause shaken investors, right? Slowed growth and a serious compensation loss to both profits and productivity if you were to pass away. So this is how serious companies will look at key person risk. They will look at these policies. So let's actually get some calculations. I want to help you be able to calculate these. Okay, so let's take a marketing agency. Okay, they have a creative director. He generates 1.5 in new business annually. This creative director also earns $200,000 in total compensation. If you were to look at the recruiting and onboarding of replacing him, it would cost $250,000 and take roughly 2 years. So we take the rule of thumb. We take 5 times their salary. Okay, so that is 5 times the $200,000. That is $1 million. We now take profit contribution. So we'll say 20% of 1.5 million is 300,000 annually. Okay, that's going to take 2 years. Now that's going to be 600,000. We'll take the recruitment cost of that 250,000, add them all together, and the suggested coverage for this key person would be a $1.85 million policy. Now I would probably just round up to 2 million because you get the tax or you get the breaks within the policy limits at that point. Okay, so a $2 million policy would be a good recommendation coverage for this example of this employee. Now, let's get into the next section. The next avenue is going to be our buy-sell agreements. Okay, this is now we're looking at succession planning. Okay, a buy-sell agreement is an agreement with when businesses have partners. Okay, and it's in the event that one of those owners pass away, the other owners or owner, right, could just be a partnership, they need to purchase the shares or the ownership of that company from the beneficiary of the deceased individual. Okay, typically those are going to be called the executor of the estate. Usually, in most cases, it's the spouse. Okay, this provides some great benefits to business owners, such as establishing a market price for the business, and then the heirs of the owner will receive the full fair valuation of the business and more assurance in the continuation of that business. Okay, so the heirs will also receive benefits such as an immediate buyout of the business, prompter settlements of an estate, and the heir is not burdened with having to run a business, right? Talk about a headache. A great question, right, to frame this is, hey, have you ever thought of this before? That if something were to happen to your business partner, that their wife would now become your partner in the business, what things would you perceive going wrong if their spouse became your partner, right? And you ask in this very kind of concerned, almost like confused tone of voice, and it's going to get them thinking of, whoa, I haven't thought of that. Like, that would not be good for my business to have their wife become my new business partner, right? And it's a great way to open those doors, because that's often what happens, okay? Because there's, a story. There's two brothers that we knew. They owned, essentially, it was valued about a $4 million construction company. And so each one, we had them take out a $2 million policy on the other. And we did have one brother pass away. He was in a car accident, and the surviving brother received $2 million death benefit and bought out his siblings' shares, right? His sister-in-law. And, his sister-in-law received that fair valuation of that $2 million inheritance, right? But then he kept full control of the business without any debt, okay? And so there's multiple ways that we can create these buy-sell agreements, which you can see on the screen here, right? We have the cross-purchase, we have entity purchase, and we also have a hybrid, okay? And we're going to talk about each of these, some of the benefits associated with each one, okay? So let's first start with our cross-purchase agreement. So this is laid out, right? Simple terms. It's when the owner purchases life insurance on each other. And so in the event of someone passing away, the death benefit is paid to the owner, and the owner can now use the proceeds to purchase the shares from the executor of the estate. Okay? That's what it's showing here. Okay? They both pay premiums on separate policies. They both own agreements. That agreement in the middle is a legal binding document, right? That's typically, you're going to involve an attorney with that to state that these proceeds are going to buy out the funds, and it's essentially a no right of refusal, right, within that contract. Like, this happens at death, the proceeds buy the shares, they give up the shares, right? That's written in the contracts. You don't have issues down the road. So when is this policy helpful? When is a cross-purchase agreement helpful compared to the other items? Okay, so it's best for smaller companies, 2 to 5 owners. Okay, and it ensures the surviving owner maintains control instead of their heirs or their outsiders. It's also helpful by providing heirs a fair valuation, just right across the board, but then it avoids outsiders stepping in, and it will prevent conflict or forced liquidation of company assets. And it will also work extremely well when this ownership stakes are unequal, okay? And so since each partner can customize the policy coverage, so if it's 40, 60, right, you can look at that valuation and get separate policies on each other for that unequal shares. Now, who is the policy owner, right? Who is the beneficiary? Okay, the policy owner is each business owner. They personally own the policy on the life of the other owner. Who is the beneficiary? The surviving owner. Okay, example, you have a 2-owner firm. Owner A owns a policy on owner B. Owner B owns a policy on owner A. B dies, A gets the death benefit, and they use that death benefit to buy out the shares of B. That's the simplicity of this, okay? So what are some factors that you need to consider when you're looking at the death benefit? Okay, you have to have the value of each owner's stake in the company. Number one, okay, the death benefit should equal the fair market value of the deceased owner's shares. Okay, you can also use a business valuation method, and this is an agreed upon valuation that is in advance. So you could look at the book value, you could look at the earnings multiplied, or you could honestly get an appraisal of the business to get that fair market value. The next thing to consider right, you always want to look at is the number of owners, because the more owners, the more policies are needed. Okay, so this is a simple formula. Okay, I say simple just because my wife is a physics major, and so I have to say math is simple, because if we say math is hard, my wife gets mad because she'll tell everybody she tutors and teaches math is not hard, it's our concept of math. Sorry, total tangent there. So that's why I say math is simple. Simple formula. You take n times, parentheses, n minus 1. Okay? That's how many you need for the policies. Okay? Yeah, sounds confusing. But remember that. So, with how many owners, you have to create that number of policies. Okay? So, each owner needs to have a portion of policies on each owner. So that way the shares equal proportionally what they're going to buy out. You also have to consider future growth. Okay, this is another factor to consider. Is our company going to grow beyond this valuation? Probably will. Okay, so coverage should reflect today's value, or you can anticipate growth. So if you're anticipating rapid growth, you can put that in there. So some agreements that you can actually put in place will say that we will actually have periodic reviews of the valuation of the company. And then you also have to be aware of, the funding. So the death benefit must be large enough to provide full liquidity to buy out heirs without debt. Okay, so that's also what you want to consider. Some great benefits of these is to have large maturity on term. You can even have a portion of some permanent policies that will accumulate and grow. You can also look at term policies that have periodic term increases, are great options as well. So some tax considerations when looking at these type of policies, you want to make sure that they are paid personally by each owner. Okay, so they're not deductible on your taxes. The death benefit, however, on the taxes will be received income tax free by the surviving owners, right? As long as they coincide with the IRC 101. Okay, those rules have to be followed. And then some other benefits and some other tax considerations that we look at when it comes to cross-selling policies is step up in basis. Okay, this is a very important tax concept, and I'll go over it briefly here for just a second. But step up in basis is when a surviving owner who buys shares, they get a step up, basis step up, that's equal to the purchasing price. Okay, this reduces capital gains tax on future sales. Okay, this is a major, I'll say that like exclamation points on the screen if we put those on there, like major tax advantage over entity purchase. Okay, and here's the reason. Okay, what is step up in basis? What does it mean? Basis, okay, that term, the word basis means your original investment in an asset, what you paid for it adjusted over time. Okay, a step up in basis resets that cost basis to the fair market value at the time or transfer, such as death or a buy-sell purchase. Okay, why does that matter? Why does that step up in basis matter? Because without a step up, okay, if an owner bought into the business for $100,000, okay, so they both invested $100,000, both owners, right? So it's $100,000 investment, and they later sell their shares for $1 million. They owe capital gains tax on $900,000. Okay, that's without a step up. Okay, so if you get those shares, you have to pay capital gains on that. With a step up, so if you get a step up basis, if they inherit or buy shares at fair market value, so because you have a fair market value and you are buying the shares at fair market value of that $1 million, the new basis is $1 million. And so if now you later sell those shares of the company, and say you sell out, a few years later, the company, you sell them for 1.1 million, now your capital gains is only 100,000. Okay, not essentially the million at that point, right? The 900,000 plus the 100,000. So that is the huge tax benefits of this step up in basis. Okay, because you are now purchasing with life insurance the fair market value, so they're getting that step up. So now you're not inheriting the capital gains. Okay. Next one. These are exciting. All right. So I want to go some advantages, okay, to this cross purchase. There's a few other things to look on the cross purchase plan, and the surviving owners, they use insurance proceeds to buy the deceased shares directly. And then with the entity purchase, okay, differentiating here, the entity purchase is the company will buy back the shares. Okay, the surviving owner basis does not step up, and they just own a bigger percentage. Okay, so with an advantage of the step up in basis, it's going to reduce future capital gains, and it means hundreds of thousands or even millions in tax savings. And then also, you have to look at estate tax. So proper planning will ensure heirs will receive fair valuation without business disruption. Let me give you a professional example that we've seen. This is a family dental practice. Okay, they had a cross-purchase agreement, and these plans are very common in the medical and dental practices. Okay, so we had a dental group. Each partner carried policies on the other. When the senior partner died, the younger dentist used those proceeds to buy out the estate. So keeping the practice intact and the patients cared for. And so when the client owner, the dental practice, they had a valuation of the dental practice at $2 million. That included the building, the equipment, and the goodwill of the company. And so the dentist had 5 children in this situation. Okay, the eldest son was the dentist. Okay, he wanted the family practice. The 4 other children, right, they were all in different careers, right? They still want their inheritance, right, when their parents pass away. So because the dad that owned the practice had a worth of $2 million, that equates to $400,000 per child, right? 5 kids divided by the 200 or the $2 million. So we actually designed a life insurance plan. It was coordinated with the client's estate documents and their will, and it was drafted by an attorney. And so it created what's called a buyout agreement between the children. Okay, and so there was a $1.6 million life insurance policy that was purchased. And so when the father passed away, the life insurance proceeds provided the $400,000 that went to each sibling to buy out the shares of the business. Okay, and so in the youngest child, they got their inheritance of the dental practice itself, fulfilling the inheritance by buying out the business shares of the other siblings. And so this was an extremely effective way to make sure that that dental practice stayed intact, the other oldest sibling, but all of the other children received their inheritance of their father's assets that he had built. Okay, now let's go into the entity purchase. Okay, so looking at an entity purchase plan, let me give you a story of Gongos. Okay, so John, he owned a business called Gongos Research. Okay, and it was a flourishing company. It more than just succeeded, like it became like an extended family. Okay, he had over 100 employees in his company, and he had this like responsibility to both care for his family but also care for his employees. Okay, so working with his insurance advisor, okay, John implemented a business succession plan that was funded through an entity purchase agreement. And the company owner The company itself owned life insurance policies on John and the other shareholders. So what happened here? The death benefit was designed so that if a shareholder passed away, the company would receive the proceeds and the company would use them to redeem the deceased owner's shares. So what does this ensure? It ensured that John's family received fair valuation. The company smoothly transitioned ownership without any outside interruption. And the employees that John cared about would have job security in the event of his passing. Now, because that advisor had that in place, tragically, John was actually diagnosed with cancer, and he did end up passing away 9 days after age 51. Okay? And because he had this succession plan in place, his wife, Anne, she received the death benefit proceeds, okay, right on his ownership shares, okay, and his business, Gongo's Research, it used the life insurance proceeds to carry out that buy-sell agreement. The business remained in the hands of the leadership and allowed the employees to continue work, okay, all because of that proper planning. Okay, when you do life insurance, these are real stories, real people's lives that are impacted, that you're saving, that you're creating these legacies for. So looking at these entity purchase agreements, okay, with these entity purchase agreements, it's also called like stock redemption, where the business itself owns the policy. Okay, so why are these helpful? Okay, what's helpful about these entity purchases versus just a cross purchase? Okay, so entity purchase works best when there are many owners, 5+ owners, okay, because it avoids the need for multiple cross-owned policies. So the business itself buys out the deceased shares, and it provides heirs with cash with a centralized ownership in the company. Okay, so who becomes a policy owner? Who is the beneficiary? The policy owner on these policies is the business itself. Who is the beneficiary? Also the business. The company owns policies on each owner's life and uses the death benefit to redeem the shares of the deceased estate. Okay, that's why these are called stock redemption. Now, what are some factors you want to consider when you're looking at these entity purchase? Value of the deceased ownership, of course. Okay, so you have to have that valuation method. You also want to look at future growth once again. Then you also want to look at liquidity needs of the business. Okay, coverage must be sized so to buy out doesn't strain any cash flow of the organization. And then you also want to look at the balance among the owners. So when the redemption should not create disproportionate ownership, okay, or tax imbalances unless that's intended. Okay, so you want to make sure that these are distributed proportionately according to ownership. Some tax considerations to look out for these ones. Of course, the premiums paid by the company are not deductible, and the death benefit paid to the company generally is income tax free, which is a nice benefit. When it comes to the step up in basis, okay, the surviving owners do not get a step up in basis. Okay, so unlike the cross purchase, it will result in higher capital gains later if they sell. Okay, so also make sure with the estate planning that the estate receives fair value in cash to avoid any conflicts. And then also, you can even look at estate planning depending on the size of the valuation. Look at estate tax laws. Other side cross purchase talk with the family. Okay, some stories behind this. Okay, there is a $15 million engineering firm. It had 5 partners. They ended up choosing an entity purchase because they only needed 5 policies instead of 20. Okay, so when the partner died, it was easy for them to redeem the shares, and the heirs were paid out, and the ownership stayed balanced behind the company. Okay, so what is now a hybrid? What's a hybrid plan? A hybrid buy-sell agreement puts some of the benefits of both together. Okay, so we have there was 4 siblings that owned a family farm, and they agreed that if one passed away, surviving siblings had the first option to buy the shares. Okay, and then if they declined, the company would redeem the shares. So how does this work? Life insurance funds both options, but this allowed flexibility to keep the family harmony and ensured liquidity as well. How does the hybrid work? It combines the cross purchase and the entity purchase. So owners can buy first. And if the owners decide they do not want to buy the shares, now the company buys the shares as backup. Okay, so why is this helpful? Okay, it's helpful because it allows that combination, that flexibility. So this is used when an owner wants flexibility in who can buy the interest. Okay, and there's tax reasons to shift between different methods. So if a business wants to ensure heirs get paid, but owners decide, hey, I want to step up in basis and get more ownership in the company, and I want to buy it directly, they have that option. So they can get that step up in basis, but say they only want to purchase, say, they had with these 4 owners, right, that's 25% shares. Say, I really just want to purchase 5% of the shares and not the 25, right? So I can purchase the 5 through this plan, right? Direct, get that step up, and then I'll have the company buy the rest. Okay. Now, policies that are structured this way may be owned by either the company or the individual, depending on the chosen structure. Okay. So who becomes the beneficiary? The surviving owners get the first option to buy the deceased heirs. If they decline, business redeems it. So the beneficiary on one policy is the other owner, and then the business is the beneficiary on the other policy. So how do we determine different factors behind this? Of course, the valuation method. You have to look at the flexibility of the spending, but then look at tax planning goals. So we have to structure these whether they want to step up in basis or not. Okay. And then with these, we also have to look at legal clarity. Okay. Because of these hybrid agreements and giving people first options, it needs to be carefully drafted to prevent disputes over who has the initial first right. Okay, because that can get dicey within a family if everybody believes they have first rights to purchase. Okay, so that has to be written out as well. Okay, this tax considerations, big one is the step up in basis. Okay, but if the company redeems it, there is no step up. And then the premiums are not deductible, but the death benefit is tax free. Okay. We're getting some good insights here. So this is a nice comparison for you to look at on these different areas. Okay. We have the feature, right? Cross purchase, best for few owners, best for many owners. For the hybrid, you have the right of first purchase. Policy owner, each partner, the business, it could be either. Step in basis, yes on cross purchase, no on entity. Hybrid, you get the option. Number of policies, there's that formula that I said, n times n minus 1. Entity purchase is just n, it's the number of owners, or you have that flexibility option. Okay, and then estate is paid by the surviving owners, paid by the business, or it's paid by either. nice quick little snapshot for you behind each of those. Okay. Now, the next part that we're going into here is understanding, the cash value when it comes to life insurance. So who doesn't love just additional cash that they get to create for their clients? Okay. Fun little multiply magic trick for you. Keep your attention here with us. Okay. Looking at, right, the ability to create and magnify money in that cash accumulation vehicles is what we're going to be talking about next. Okay. So when it comes to a medical practice, there's a medical practice who actually bought whole life policies on the founding physician, and he had that policy for 15 years. Okay. And that cash value that he had put into that permanent policy had grown into the millions. Okay. And so this owner, he actually had an opportunity to expand into a new clinic. And so instead of borrowing from a bank, he actually borrowed from his own life insurance policy, and he avoided debt, and he was able to grow his practice from that. Right? Talk about a cool use of a life insurance policy while he's still alive to grow his business. Okay. Now, there's a few things to consider, right, when it comes to these cash accumulation vehicles. They are permanent policies, and they will build tax-deferred cash value. Okay. Some uses that you're going to look at for the business is going to be liquidity downturns, right, executive benefits, supplemental retirement funds, or even buy-sell funding, which I mentioned before. You can have both the term and permanent. So when is this helpful? Okay, this is very helpful when a business has strong cash flow. Okay, and they want some tax advantaged plans to build assets outside of traditional retirement plans. Okay, so when a business needs a source of liquidity to cover different opportunities or even business emergencies, or you can even look at to have an executive benefit. Those are some good, helpful resources of these cash accumulation vehicles. Some other avenues that we can look at is when an owner wants to combine protection with savings rather than having separate products. And then you can also look at long-term strategies such as deferred compensation, supplemental retirement, or funding of these buy-sell agreements. Okay. A great avenue for deferred compensation plans as well. Now, let's look at who is the policy owner, who is the beneficiary on these policies. Okay. When it comes to the owner, the business is the owner and the beneficiary of the permanent life insurance policies. The insured is usually the key owner or the executive, and the business will pay the premiums. They build cash value inside the policy. They can access the fund through policy loans and withdrawals if they need it. And then upon death, the business receives the death benefit. It provides continuity and liquidity that these companies need. So, factors to consider when looking at these, okay, is how much liquidity does the business want to maintain for future growth. You also want to look at policy selection, okay? You can look at whole life, which has some guaranteed, some steady growth. You could also look at universal life that has some flexibility. You could also look at variable life that has some market exposure. You also want to look at all of those considerations. And then you also want to look at the premium funding level. Okay? Overfunding within IRS guidelines will accelerate the cash value growth. Okay? So looking at the TAMRA 7, looking at what the IRS guideline is, and overfunding these policies simply accelerates the cash value growth. Okay. Some death benefits, you need to look at it of maintaining key financial risks to the business. You could look at the buyout, you could look at debt coverage, you could look at executive replacement. And then the death benefit should also align with the size of the cash value desired. Okay, because of those IRS limits to maintain the favorable tax statuses, you have to look at, if I want to accumulate this amount, I need a minimum of a death benefit this so I can overfund it and accumulate that amount, right? Because you can't overfund what the IRS says. You need to increase death benefits so you can fund it more. So you have to consider that. Now, when it comes to tax considerations, these premiums are also not deductible, but a gross tax deferred. Okay, the cash value is that tax deferred. The loans and withdrawals can be accessed tax free if you structure them properly. Okay, the death benefit is generally income tax free. Of course, we have the regulations that have to be met, as I've talked about before. But this essentially, it's like a corporate ATM. Okay, companies have used these historically to look at these death benefits of these proceeds to help with those emergencies or different things in the business. Okay, so it's always advisable as well when you structure these policies to partner with their CPA. Okay, look at their, if they have a financial officer, those over accounting, or if they have a CPA, it's good to work with them on these policies to look at the death or the tax advantages that these have. Okay, life insurance, as in a accumulation vehicle, isn't just about insurance. It's about combining protection, liquidity, and tax efficiency all in one structure. Okay, so for businesses, right, it's going to create an asset on the balance sheet. It's going to provide tax-deferred growth and liquidity access, and it delivers a death benefit safety net as well. Okay, so let's look at this story here of Mike. Okay, Mike took a wealth of experience. He ended up building his own company. It was a metal recycling business, and his insurance professional offered him advice to put a whole life policy in place that protected his family and built the cash value needed. So when the 2008 crisis hit, his business took a big blow when the market contracted and several major overseas clients were unable to pay their bills. So Mike thought of his death benefit for his business because his banks had actually withdrawn their lines of credit. And so he used the funds in his permanent, and he was able to keep the business afloat. Okay, he was able to use that, the cash value growth, so he didn't have to lay off employees. He was able to cover the bills. He was able to make it through that. But without it, we don't know what would have happened to that business, right? It probably would have had to close. Okay, but that infusion of money on that loan against the cash value allowed Mike to regroup, keep the business going, and it also protected his family and their financial well-being. Okay, so these are really powerful policies that you can utilize for the business. Some of the next ones, right, when it comes to these cash value vehicles, is to secure loans and lines of credit. Okay, so when we're looking at these loans, the Small Business Association, okay, SBA loans, right, we had a small manufacturer. They took out a $2 million SBA loan, and the SBA actually required life insurance on the owner in order to, and assigned the bank as a beneficiary in order to get that loan. Okay, so if the owner passed away unexpectedly, the policy would pay off the loan. Okay, the bank wanted protection. Okay, so when it comes to these type of policies, the business can take out a loan on, or the business can take out a life insurance policy to cover the loan or the line of credit they want. Okay, it can offer collateral to those lenders with that life insurance policy if they were to pass away. Okay, so how does it work? Okay, the policy is collateral assigned to the lender, and so if the insured dies, it is repaying that lender with the death benefit. Any excess proceeds beyond the loan balance will be paid to the owner's beneficiary. which is nice. Okay. While the insured lives, the business can also have some cash value accumulation. Okay. With lender approval. Oftentimes the lender has to approve that aspect. So make sure you look at that. And this structure will actually reduce the lender's risk and make it easier for businesses to qualify for that financing. Okay, so helpful when you're looking for an SBA loan, maintaining the guidelines. If you have 20% interest when repayment depends on them. You can also look at startup who rely heavily on an individual for revenue. You could look at large financing needs for equipment or expansion, or even some buyouts where the financing is secured and the lender wants assurance. Okay. So going over who is policy owner. Policy owner is usually the business or the individual owner. Who is the beneficiary? The lender is primary, and they will take the amount of the loan via a collateral assignment in that contract. The secondary beneficiary is going to be the business or their designated heirs. So they'll receive the remaining balance. So if you're paying off your debt, now you have remaining balance in that life insurance, that's going to go to your heirs. Okay? The loan just needs to be satisfied. That's all the bank cares about. Okay? So factors to consider. What is the loan amount? Okay? How long is the loan term? Right? Is it 20 years? Is it 30 years? Is it 15 years? Is it shorter? Is it 5 years? Okay. You also want to look at future borrowing, right? So you may want to expand into the future, right? And you'll need another loan. And then, right, do you want any cash value considerations? You also look at that. Okay. Now, the loan repayment for tax considerations, the amount paid to the bank is not taxable, but it reduces what's left for the business or the heirs. Okay. You have to have the notice and consent rules. If the employer owns a policy, the insured must consent in writing that they have this policy. Okay. And then also with the tax consideration, you have to look at assignment. It has to be carefully documented to avoid disputes over the proceeds going to the lender and so forth. Okay. Now, another real life story. This was a developer that had a $10 million credit line. They had purchased a permanent policy and they assigned it as collateral to the lender. Not only did it satisfy the bank, but the cash value also improved loan terms, and they were able to secure better financing and were able to use it for future projects moving forward. Okay, pretty cool asset there. Now, next one. Employee-sponsored life insurance. Okay. Here's another story for you. There's a 75-employee law firm, and they're offering group term insurance equal to 2 times their salary, and partners' earnings for $150,000 and $300,000. Okay. What did this do for their company by simply offering this benefit? It boosted morale, it improved retention, and it gave some employees peace of mind. Okay, when employees look at staying with a company, benefits are number 2 on their list. Okay, this is statistical research that's been done. The number 2 thing they're looking at is employee benefits. Okay, so just adding these can provide that peace of mind. It can improve that retention of employees. Okay, so there are 2 main types of employee-sponsored coverage. You have group term, and then you also have executive compensation. Okay, so group term, when is it helpful? Okay, what does it do? The employer is the policy owner, and the employee gets to choose beneficiaries. Or not the employer, the employee. Sorry, I said that wrong. The employee gets to choose their beneficiaries, which is nice. And coverage is usually 1 to 2 times their salary, or you can have just flat amount increments. And coverage is generally renewable annually. And that's an important thing to remember. These group policies are annual renewable terms. Okay, so that means you're going to have closer price breaks, oftentimes annual price breaks depending on their age. Okay, does not build cash value. Another thing to remember. So when is it helpful? When you are creating employee benefit packages. These are used to attract and retain employees and offer affordable protection. Good for small businesses, allows employees to provide valuable benefits without the complexity of individual underwriting. When you have large employers, right, it's easy to scale these. You can cover hundreds or even thousands of employees under one contract. And you also have supplemental coverage. Employees may often be able to buy additional coverage at group rates, which is really nice and really helpful. Okay, so businesses as policy owners and beneficiaries. Okay, when we look at who is the policy owner, it is the employer, it is the business. Who is the beneficiary? The employee's chosen beneficiary. They get to choose who they want their beneficiary to be. The businesses pays the premiums, sometimes fully, or sometimes with shared monetary value with the employer or employee. Okay, so the employer and the employee will fund a portion of it. So what are some factors to consider? Factors to consider, you can look at a salary-based formula. Common is 1 to 2 times salary. Executives may be higher. You can look at flat dollar amount, 50,000, 100,000 per employee. Okay, you look at retention and competitiveness. Higher coverage can make a benefit package more attractive. You also want to look at cost versus value. Employer balance with the affordability and coverage. Okay, you want to balance that. Group policies can be inexpensive, but may not provide adequate coverage compared to individual policies. Okay. Now, some tax considerations to look at is these are deductible as business expenses. Okay. So employer premiums are deductible as business expenses. That is a good tax consideration. Okay. The first $50,000 of group term coverage per employee is tax-free. Coverage amounts above $50,000 create inputted income for employees according to IRS Section 79. Okay, so death benefits are generally received income tax-free as well. So make sure you are looking at that first $50,000 of a group term life insurance coverage. Okay, the next one looking at is the executive bonus. Okay, the executive compensation. Okay, so this is AKA what we call the golden handcuffs. Okay, these plans are used when an owner wants to retain an employee and offer additional bonus to their employee to incentivize them to stay with the company long term. Okay, an executive bonus is what's called a non-qualified plan. It is also considered a 162 plan, and it is under which the key employee owns a permanent life insurance policy on his or her life. The employer pays the life insurance premium indirectly by means of a bonus paid to the key employee. The additional income used to pay the premium is deductible by the employer and reported by the key employee as compensation. Now, often the employer will also increase the income to cover the extra taxes associated with the increased income, and this is what's called a double bonus. Okay, so these plans are written in permanent policies that generate cash value. They are typically have contingencies, such as an employees required to work for the company for a period of 10 years in order to have access to the proceeds. Others would be that if the employee dies in the duration of employment, the death benefit is paid to the company. And other ones would be these plans are also written by an attorney in contractual agreements. Okay, so that way you just can't take your bonus and just not fund a life insurance policy. Okay. So these type of bonuses are attractive to employees as they can provide a nice supplement to retirement completely paid for by the company. And these policies, it can be portable if they leave. And you can also add riders for terminal illness if needed. And employers also benefit as the premiums are treated as compensation, and so thus they are tax deductible. And what's really nice is there is no IRS pre-qualifications or reporting. And you can actually choose who receives the benefit. You don't have to offer it to everybody. You get to choose, and you get to choose how much they receive. Okay, so super helpful when you're recruiting and retaining talent. Okay, it goes beyond traditional salary and 401k benefits. Okay, it is the golden handcuffs. It encourages executives to stay because the benefits are tied to longevity. Okay, you can also look at it as owner succession planning. You can also look at tax leverage, right? Provides death benefit plus tax advantage income streams for executives. Okay. Now, this is important. Who is the owner? Who is the beneficiary? Okay. In a bonus plan, the executive is the policy owner and chooses their own beneficiary, okay, according to contract. And the businesses pays the premiums as taxable compensation, right? So they're indirectly paying for these premiums. Okay. You could also look at a split dollar plan, and that is when the business is the policy owner and the beneficiary, at least for a portion of the benefit. Okay, and the business may recover premiums or loan values, while the executive heirs may also benefit as well. Okay, but they are going to be structured depending on the goal. If the goal is retention, if it's income supplement, or if it's estate equalization. Okay, depends on what you're looking at. Factors to consider: the value that the executive is to the company. You can give larger benefits for more critical roles. If you want to look at retention goals, death benefit should be significant enough to have meaningful retention, right? You want to design the plan if the plan is primarily for the death benefit or if it's for cash accumulation for their retirement income. You could also look at, the cost and rewards. The premiums must be reasonable relative to the executive compensation and within the company budget. Now, tax considerations. These are considered 162 plans. So premiums paid by the business are deductible as compensation. The executive reports the premium as taxable income. The death benefit to the executive's beneficiaries is income tax free. Great tax advantages here, okay? Now, there is a high-tech company, okay? It was fast-growing, and its CTO, its Chief Technology Officer, was offered an executive bonus plan, funded with the whole life, in order to keep the CTO with the company, okay? It allowed him to say, yes, I will take my skills, my knowledge as the Chief Technology Officer, and I will stay here, okay? He later used that to supplement his retirement benefits as an executive, right? It built loyalty, it provided tax-deferred growth for that individual. This is an example of a simple executive bonus, okay? Hypothetical contract, just written illustration of what this looks like, okay? So up there you have the double bonus example, okay? So if they're in a 24% tax bracket, you give them the $10,000 bonus to pay for the life insurance premiums, plus you bonus them an additional $3,158 because that pays for the additional taxes they're going to pay that year. It's called the double bonus. Okay, so you look at this. If you start them in the company, that executive is 30 years old, you fund this till they retire at 65, you're putting in $10,000 as a bonus for that individual. That cash value, right, that second to last column, is close to $900,000 that the employee will get tax-free. Okay, but there's also a death benefit of $1.3 million, right? So it has all of these great benefits, both tax-wise and professionally-wise, to retain those employees. Wow. Okay, so in summary, okay, we've seen a lot of these business uses of life insurance. Okay, Life insurance is far more than just protecting a family. It is a business tool. It protects key employees. It can fund succession. It builds liquidity. It can secure loans. And it can also reward your employees. Like, these are incredible assets and tools if used properly. Okay? So, if you're the owner, the executive, if you are writing business owners, life insurance is both a safety net and a strategic asset. Okay, you've heard through these stories, you've looked at startups, we've looked at like large corporations like Starbucks. Okay, we've looked at dental groups to construction firms. Okay, all of these, they had proper planning in place that created meaningful difference for both their families and for their company. So thank you so much for joining me today. I hope to hear some stories of how you've been able to use these life insurance options with your business owners, right? It is not just a policy, it is a plan for legacy and performance. Thank you so much, everybody.